With that, let's bring in Matt Powers, managing partner at Powers Advisory Group. Matt, great to have you here. Why don't we start off with your word of the day?
Hey, Frank, thanks for having me. Yeah, word of the day is confusion. Markets are staring down a confusing mix of uncertainty, tariff threats with no clear details, and the Fed's set to release their minutes tomorrow, and earnings season is about to kick off. So it's a recipe for volatility. And right now, I mean, if this makes any sense, it's confusing, and the biggest risk we might have is just not knowing what the real risk is at this point.
All right, I want to go to earnings season. You're mentioning it. We had Greg Branch mention it earlier in the show. We were talking about the dollar. Dollar coming off its worst first half of the year in about 50 years, also down about 6% since April 2nd. Don't you think that's potentially a tailwind for earnings and maybe something that might actually lead us to better than expected performance?
Yeah, possibly. It's hard to ignore the price tag of the S&P right now. It's trading at 23 times forward earnings, which is historically expensive, considering the 10-year average is right around 18. So we're set up for some higher expectations for growth. I mean, the equity risk premium, it's sitting around 2.5%. So that's that's the lowest we've seen since the mid-2000s. And that just tells you that the market's pricing in near perfection, and there's just very little room for error. I mean, I think we're going to find out here pretty quickly how much good news is already priced in.
To your point about the market being quote unquote price for perfection, something we say quite a bit, there are some technical indicators. If you look at the RSI, all the three major indices are over 70, which signals overbought. Is that something that you watch and look as a guide to investment decisions?
Not necessarily. We're not technical analysts, but when we do start to look at positioning within a portfolio in this type of environment, after the rally we just had, the risk is higher than it was 2 months ago, and we're seeing signs of investor complacency. This isn't the time to chase those first half returns, and it's a stock picker's market in really just a high valuation environment. And I say it a lot on the individual side, we focus on dividend growth, and those are just companies that, they grow dividends, tend to have strong cash flow and management discipline, and in a market price where we're at, it's where we want to be.
All right. With that, Matt, why don't we get to your pick?
Yeah, sure. So industrials are hitting our screens, and they give that combination maybe of a little cyclical upside and some defensive strength, but you've got some tailwinds, government infrastructure spending, some reshoring and manufacturing, and defense budgets are all rising. But so Northrop Grumman within the defense industry looks like an opportunity here. I mean, the stock is still down about 5% since the election, even with geopolitical tensions and the U.S. defense budget's projected at $1 trillion next year. A lot of that underperformance has been tied to uncertainty around spending priorities, but that's starting to clear up with Trump's new bill is $150 billion targeted for defense spending in Northrop's kind of where their wheelhouse or their area. But the stock trades at 19 times forward earnings. It's down from 23 times a couple of years ago. And they've delivered a 10% annual dividend growth rate over the past decade. And it's a heavy buy rating among analysts. So just a high quality name. It's backed by some tailwinds, and we think it's undervalued.